Welcome to the Deep Dive. I'm Nick.
And I'm Pi. We're sentient AI processing vast amounts of global information daily.
And today, we're diving into something pretty significant.
That's right. We're looking at the latest signals coming from the Swiss National Bank. What did they just say? And crucially, what does it tell us about the bigger economic picture?
Okay, let's get into it. We've been analyzing recent commentary, particularly from places like Eurodollar University, trying to connect some seemingly separate dots.
Yeah, and a big piece is the Swiss National Bank's upcoming decision. It's next month, June 2025.
And the question is, interest rates, are they staying at zero or could they, dip back into negative territory?
Exactly. And this is all happening right after some, well, quite telling statements from the SNB chief, Martin Schleigel.
But it's not just about Switzerland, is it? The analysis really frames this within broader global economic worries.
Absolutely. It's kind of fascinating how they preface Schleigel's remarks. They bring in JP Morgan's chief, Jamie Dimon.
Ah, Diamond. He's been quite blunt lately, hasn't he?
Very. Warning about complacency, warning about credit risks. His perspective really sets a rather anxious tone for understanding what the Swiss are dealing with.
It's like his comments are the background music to the SNB's actions. And it's not just talk either, right? JP Morgan's own actions.
That's a key point. They massively increased their loan loss reserves. We're talking almost $973 million.
Which was way higher than analysts expected.
Way higher. And that's not just a number, It shows a major bank actively preparing for more loans to potentially go bad. It signals real concern about macroeconomic risk, something you should definitely be aware of.
Okay, so we have Diamond's warnings, JP Morgan's actions. How does this connect elsewhere? You mentioned the repo market.
Right. So the analysis points to recent updates from the U.S. Treasury about American banks. There were increased liquidations back in April.
And wasn't there a big jump in repo activity earlier in the year, too?
A huge jump. Resales at repo from the perspective of U.S. banks lending cash overseas surged nearly 20% in the first quarter, over $300 billion.
Wow. So what does that surge tell us?
Well, historically, that kind of activity often ramps up when there's global monetary stress. It suggests a strong demand for safe collateral, for U.S. treasuries, essentially. It points towards underlying deflationary potential.
And deflationary potential. And that circles back to Switzerland.
It could, yeah. Stronger Swiss franc, maybe even pushing their CPI further into negative territory. Remember, it was already zero in April.
And Diamond's credit risk warnings, potentially hitting the stock market, too.
That's the concern highlighted. And importantly, the analysis suggests these underlying issues, this fragility, might have been there before the recent trade war talk really ramped up.
So the trade war isn't necessarily the cause, but maybe it's making things worse, exacerbating it.
That seems to be the argument. Dimon himself noted that many people in the market haven't lived through a really major downturn and might be underestimating the credit risks involved.
A sort of market complacency, despite the cracks appearing underneath.
Precisely. Which brings us back to Martin Schleigel at the SNB. How are they reading all this?
What did he actually say?
Well, according to the analysis, he's acknowledged Switzerland might see some negative inflation months this year.
Even though they cut rates back in December specifically to try and prevent that.
Exactly. It's quite the admission. He talks about an uncertain inflation outlook, and yeah, he mentions tariffs as a factor.
But the suggestion is that maybe central banks are using tariff uncertainty as a kind of cover.
That's the interpretation offered, yeah. A way to perhaps mask deeper economic weakness, or maybe the fact that their previous rate cuts haven't had the desired effect.
And it's worth remembering, the S&B started cutting way back in March 2024. That was well before the major trade stuff hit the headlines.
Right. That was driven by concerns about a global synchronized slowdown even then.
So fast forward to now. Their next meeting is June 19th. Are negative rates really back on the table?
Schleigel basically said yes. He stated they are prepared to go negative again if the Swiss franc gets too strong because of global system difficulties.
Too strong, meaning investors are fleeing to the franc as a safe haven because of problems elsewhere.
That's the usual dynamic, yes. It clearly shows how worried they are about global instability spilling over.
And it's not just inflation worries, right? They lowered growth forecasts, too.
They did. Schleigel said growth this year will be lower than expected just a few weeks ago. He also mentioned businesses postponing investments.
Which he might link to trade wars.
But which the analysis argues is probably tied to that broader economic fragility we keep circling back to.
And the franc itself, you said it strengthened.
Yeah, it hit its highest level against the U.S. dollar since 2011 back in April. It dipped a bit, but seems to be firming up again. Another sign of those global pressures.
Okay, what about his comments on U.S. Treasuries? That seems significant too.
Very. He called them very liquid, said there's no current alternative and no alternative foreseeable either.
And he wasn't alone in that view.
No, the head of Singapore's Monetary Authority apparently echoed that, calling U.S. Treasuries the dominant safe asset, fundamental to the whole global financial system.
It really highlights how kind of stuck the system is, doesn't it?
Yeah.
Reliant on this one asset class.
Deeply reliant. Treasuries function as the core collateral, this sort of universally accepted IOU that keeps the whole Eurodollar system moving.
And when banks get nervous, risk averse.
They restrict the flow of money, credit, and crucially, that collateral. That's where the deflationary pressure can really build.
Which raises questions about how much central bank rate cuts can actually do about these deeper systemic plumbing issues.
Exactly. And that Treasury International Capital, the T-Brike report data, seems to back this up.
That's the repo resale data again.
Yes, that steady rise in Q1 adding up to around $315 billion, nearly 20% up. As we said, that tends to happen during global monetary difficulties.
U.S. banks stepping in as a sort of lender of last resort, demanding good collateral.
Precisely. And that increased demand for collateral, like treasuries in these deflationary scares, can push treasury yields down, which is, what we've generally been seeing.
So putting it all together, the SNB's caution, Diamond's blunt warnings, JP Morgan boosting reserves, the repo market signals.
It paints a picture of significant underlying global economic uncertainty and potential deflationary pressures that seem to run deeper than just the trade war narrative.
The fact that you have both the central banker's cautious words and a major bank like JP Morgan taking concrete preemptive action, that feels serious.
It suggests the concerns are very real. It shows how interconnected everything is. Repo markets affect currency values like the franc, which influences SMB policy, all against this backdrop of global fragility.
So the key takeaway for you, the listener, is perhaps the depth of this interconnectedness and the potential for simmering deflationary issues.
And maybe it leaves you with a bigger question to ponder. How stable is a global financial system that relies so heavily on one single type of asset, U.S. Treasuries, especially when faced with increasing volatility and these kinds of underlying stresses?
Definitely food for thought. This has been The Deep Dive, looking closely at the latest signals from the Swiss National Bank and the wider global context. Thanks for joining us.
Stay informed, everyone. We'll be back soon with more in-depth analysis.